The more money that we can put through our warehouse gives us a larger amount that we can borrow from. And as I just explained a minute ago, we want to pay ourselves back honestly. We don't have to, it's an unstructured loan. But if we pay ourselves back, like in the example of Julia there, where I had her paying back that auto loan at 5%, we pay ourselves back. Now we're the ones making that 5% interest, not a banker. And all of that is going to help us now toward retirement. So let's move into that final one. To supplement our retirement income, we've talked now about 5 of these myths, and we're still on this one here, taking out a loan. But now we're going to talk about taking out a loan in the retirement years of our lives. So they combine with myth 6, you lose your cash value when you die, and also whole life insurance won't help you during retirement. So it's really these 3 combined that we're going to be looking at right now.
Which is better, saving in an IRA or an insurance policy? That's interesting. Life insurance wins hands down. Let's compare. Let's compare life insurance to a tax-deferred retirement plan like an IRA or a 401k. If you compare life insurance to tax-deferred plans, life insurance has several advantages. First, with life insurance, you have lifetime access to cash value, tax-free and penalty-free. With an IRA, withdrawals can be heavily taxed, and penalties too. Also with an IRA, after you're 70 and a half, you're forced to withdraw and pay taxes whether you like it or not. Life insurance provides a tax-free death benefit, income tax-free, estate tax-free too if owned properly. And with life insurance, there's no risk of future tax rates increasing. I mean, they could increase, you just don't care. With life insurance, you don't get a tax deduction like you get with an IRA or 401k. But a tax deduction these days is a trap because you'll pay much more in taxes later.
Back to Julia. We're going to talk about how you lose your cash value when you die. That's one of the myths out there. Let me explain how that works, because it is an accurate statement, but I want to explain why what we're being told. It's kind of irrelevant. Remember, in year 16, so these are actual numbers, year 16, she puts in 12,000. Her total net cash value increases by almost 23,000, and her death benefit increases by almost 32,000. A couple years later, 10 years later, when she puts in only $3,000, she still has a net increase in her cash value by nearly 20,000, and her death benefit has now gone to over $1 million, but it increased during that time period 10,000. Here's what's so powerful. Now at age 71, she hasn't been paying into this thing for 5 years, right? No payments at all, yet still her net cash value has increased by $25,000 that year, and so has her death benefit. Try that on term insurance when you're 71 to go get it paid for and increase and have $1 million. That isn't happening, but that's another story. Anyhow, this is the point I wanted to make, that her death benefit has continued to grow year over year over year. But here I have her taking out no money at all. Now we're going to show what happens when she begins to take some money out on an annual basis to help supplement after we decide to retire. So instead of the zeros that we had right there, now I'm going to show you what happens if she takes out $25,000 a year starting at age 66 to help supplement her retirement. Okay, so she's now taking out $25,000 tax-free. Why is it tax-free? Because she's borrowing it from the insurance company, and she's never planning on paying it back. Okay, again, she has that positive spread, so what she borrows, she's still making more because of the cash value that she has in her policy. Okay, so here's her cash value, and note, every single year this column also grows even though she's taking out a loan for $25,000. I've highlighted 78 because that is the average age that a female lives to in the United States today. So let's bracket that by, say, 2 years before and 2 years after. Somewhere in here, let's assume that Julia takes ill. When my parents both got terminal cancer, we as a family had about a year to a year and a half warning before they finally passed away. That was time that we could spend. We got together and had a wonderful Thanksgiving with my mother before she passed and got the whole family there. We knew she had terminal cancer and we all got together. What I'm trying to point out here is that she has, in year 78, let's say she's like my mother and gets terminal cancer, and it takes a year before that cancer finally takes her away. She has $372,000 sitting here that she could borrow. She doesn't just have to borrow the 25 that I've put into this thing, right? She could borrow this entire amount if she wanted to. Knowing that she's going to pass away, who cares, right? It's her money. So the statement in and of itself is accurate that you do lose your cash value when you die. You don't, because your cash value is a subset of your death benefit. So if she were to get in a car accident at age 78, unexpectedly, her family would get $568,000 in the death benefit. But if she contracts a terminal illness and needs to borrow some of that money, she can do that too. That's my point. It's available. Another important thing to note too is that $25,000 tax-free, if she were out trying to earn that money right now, she would have to earn somewhere between $35,000 and $45,000 a year to get $25,000 tax-free. So, her total deposits between age 41 and 65 were $255,000. Now, she's borrowed back $325,000 through age 78. Right? And she still has this available to her, $372,000. But let's say that nothing happened to mom or dad at age 78, or Julia Roberts in this case. She makes it all the way to 85. Now let's look at what she's got. $425,000 in cash value. What if she takes ill now at age 85? That's more probable, right? Well, her death benefit is still $817. Pay attention to this though. Her net death benefit has been going down. Why? Because Julia has been borrowing $25,000 every year. So she's borrowed $25,000 for 20 years, tax-free. That means that she's put $500,000 in her pocket during the last 20 years, even though her total deposits when she was building this thing were $255,000. Not bad, right? She puts in $255,000. She's now been able to borrow $500,000 tax-free over those years. But let's say she makes it all the way to age 90. She's still going to leave her family $266,000 in a death benefit. So here's the real fact. You can use your cash value until you die and still leave a death benefit. That's the powerful part about whole life insurance.